Welcome. Today, we are cracking open the world of equity derivatives. Now, I know that sounds like a bunch of Wall Street jargon, but trust me, these are incredibly powerful tools. They can literally change the entire way you think and interact with the market. So let's just dive right in. You know that feeling, right? That pit in your stomach when the market starts to tumble and you're just watching your portfolio's value go down, feeling totally powerless. But what if you weren't? What if there was a way to buy insurance for your investments? You know, the same way you insure your car or your house. Well, that's exactly the kind of power that derivatives put on the table. So here's how we're going to break it all down. First, we'll look at the three big goals that drive pretty much any investor. Then we'll get into the actual strategies. Hedging as your financial shield, speculation for making those educated bets, building some more advanced spreads, and finally, we'll hunt for market glitches with something called arbitrage. Okay, before we get lost in the weeds of complex strategies, we need a really simple framework. It turns out that every single derivative strategy, no matter how complicated it seems, really just boils down to one of three basic motivations. If you can get these three, you'll understand everything else we talk about today. Just think of it like a game plan. You can play defense and protect the assets you already have. We call that hedging. You can play offense, trying to profit from where you think the market's going to go. That's speculation. Or you can be the person who finds a glitch in the system and uses it to make a guaranteed profit. And that's arbitrage. Defense, offense, or finding the glitch. Every single strategy fits right into one of those buckets. Let's kick things off with defense. Hedging is, without a doubt, one of the most important and, frankly, intuitive uses for derivatives. This isn't about hitting home runs and making massive profits. Nope. This is all about protecting the value of what you've already worked hard to build. So in the plainest possible terms, hedging is financial insurance. It really is. You're basically paying a small price or maybe agreeing to limit your potential gains in exchange for protecting yourself from a really big, painful loss. It's all a trade-off. You sacrifice a little bit of the potential upside to get rid of that terrifying downside. Okay, let's make this totally real. Imagine you own a decent chunk of stock, and you know you have to sell it in 2 months to, say, pay for college tuition. What's your single biggest nightmare? That the stock price crashes right before you need to sell, right? This is the absolute perfect situation to use a hedge. And the solution here is what's known as a short hedge. You sell a futures contract. Think of this as a side bet you're making that the stock's price is actually going to go down. It sounds weird, but this way, if the price of the shares you actually own falls, the profit you make from your side bet on that futures contract can cancel out the loss, protecting your money. And check this out. Here's how it all plays out. Without the hedge, if the price drops, you take a big loss. Simple as that. But with the short hedge, yes, your stock's to loses value, but look, your futures position makes a profit. The two almost perfectly cancel each other out. You've just turned what would have been a major financial hit into a near break-even. That's portfolio insurance in action. All right, enough defense. Let's switch gears and play some offense. So if hedging is all about avoiding risk, speculation is about embracing it, all for the chance of a big payoff. This is where traders use their research and their gut feelings to make educated bets on which way prices are headed. And you know, speculators are absolutely essential for a healthy market. They are the ones who take on the risk that the hedgers are trying to get rid of. And by doing that, they provide the liquidity that actually makes the whole system work. They're basically betting that they can see the future just a little bit more clearly than everyone else. Now, this slide gets to the heart of why speculators love derivatives: leverage. See, buying stock costs a lot of money up front, but with a futures contract, you can control the exact same amount of stock by putting down just a tiny fraction of the cost, something called margin. This means a small price move can lead to huge gains, but, and you have to hear this part, it also magnifies your losses just as easily. Leverage is a very, very powerful double-edged sword. So we've looked at pure defense and pure offense. But what if you want something in the middle? Well, this is where it gets really cool. Traders can actually combine different options contracts to create totally custom strategies that limit their risk while still leaving room for profit. Let's build one of the most popular ones together. It's called a collar. All right, let's do this step by step. First things first, we start with our basic position. You own the stock. And as you can see from this pink line, your potential profit is, theoretically, unlimited if the price goes up. But so is your potential loss if the price goes down. Okay, for step 2, we're going to sell a call option. Now think of this like you're agreeing to sell your stock if it hits a certain higher price. Just for making that promise, you get paid some cash up front. That's the premium. So what's the catch? Well, you've just put a ceiling on your maximum profit, and you can see that right where the yellow line flattens out. And now for the really clever part in step 3. You take that money you just made from selling the call, and you use it to buy a put option. This put option is your insurance policy. It gives you the right to sell your stock at a specific price, no matter how low it drops. You've essentially just created a price floor, a safety net, and you can see it right there in that light blue line. So when you put all 3 of those pieces together, what do you get? You get this dark blue line. This is the collar. You gave up some of that unlimited potential profit, but you used the money from that to completely eliminate your downside risk. You've created this defined channel where your profit and your loss are locked into a very specific range, no matter what crazy things the market does. We've covered defense and offense. Now it's time for that third goal, finding the glitch in the system. This is called arbitrage, and it is all about finding tiny, temporary mistakes in pricing to generate a profit with, at least in theory, zero risk. You can think of arbitrageurs as kind of like the market's referees. They find these weird situations where the exact same thing is selling for 2 different prices. And by jumping in and trading, they force those prices back into alignment. They're basically hunting for logical errors in the market. And one of the main rules they enforce is something called put-call parity. Now, don't worry about the math formula. Just think of it like a law of financial physics. It says that a stock, a call option on that stock, and a put option on that stock all have to have a very specific price relationship. If that relationship breaks, even for a split second, a glitch has appeared. And this table is the proof in the pudding. When an arbitrager spots one of those glitches, they instantly buy whatever is underpriced and sell whatever is overpriced. And just look at the result. It doesn't matter if the stock goes up or if it goes down. The final payoff is exactly the same. It is a locked-in, guaranteed profit. So, if there's one thing to take away from all this, it's that derivatives aren't just one thing. They're incredibly versatile tools. You can use them to play defense with hedging, go on offense with speculation, or act as the market referee through arbitrage. Every super complex strategy you hear about is really just a new combination of these simple building blocks. And that brings us to our final question for you. We've seen how these strategies are all driven by very different human emotions and motivations. Hedging is driven by the fear of losing money. Speculation is driven by the desire for big gains, or greed. And arbitrage is driven by pure, cold logic. So, what do you think is the most powerful force in the markets today? Fear, greed, or logic? And that's all the time we have for this explainer. Thanks so much for watching.